Hello, everybody. Good, whatever it is, wherever you are, and whoever you are. The ECB has published its framework, its new framework. Now, what does this actually mean for you, for the euro, for you, European assets? Let's look at it. Okay, first of all, what did the ECB do and what did it not do? The first thing it did was to change its inflation target. And after many debates, it actually decided that it would move its inflation goal to a, I quote, symmetric 2% from below, but close to 2% over the medium term. That's the first change it made. So it's aiming at 2% and not something below 2%. The second thing is it's going to progressively, when it can work out price indices that actually reflect housing appropriately, it's going to include what is the European House Price Index, the HICP, into its own inflation targeting, which would add maybe 0.2, maybe 0.3% to the current rate of inflation you hear about in Europe. Now, they're really the two things which it does. The third thing, which is highly technical, but I will mention, is that it allows itself to have a short-term, not permanent, and no way like a catch-up on past performance inflation target over its goal if monetary policy has gotten interest rates to the zero bound and there is a risk that both the inflationary expectations become below target or even deflationary. But that is a very technical thing. What the ECB did not do, and I think that's extremely important, is tell us how it was going to achieve these targets. Now, there is a conference, which is one of the most inbred conferences in the world after Jackson Hole, which includes only academics and central bankers and worthies, in which the ECB will progressively, up to that date of that conference in September, publish all of its 11 or 12 research papers into every single aspect of revising its framework, including how many lumps of sugar you can put in your coffee if you're sitting in an ECB meeting. So that will be very exciting and highly unreadable, as usual, with these papers, but it will not change chalk from cheese. The ECB did not tell us how it was going to achieve its goal. Most importantly, perhaps, it is wise to remember that the ECB did not do what the Fed did when it revised its framework. What the Fed did was to say, well, if we have underperformed our inflation target for X years, then we will allow inflation to run above our target for an amount of time during which the gap, the underperformance, is plugged by inflation being above target. So in other words, the Fed is in reality running an inflation target which is a general price level target, where underperformance, under lower rates of increase than they hoped in that index, that target of prices, of general prices, would be compensated by a higher rate of inflation, which would then make the target price level achievable, taking the historic period and taking the future period. The ECB did nothing of the sort. If the ECB was to have a compensatory price target, allowing it to overshoot to make up for its underperformance of its inflation target in the past, we would be running at very high rates of inflation for the next 10 years, because in reality, the ECB has never gotten near its target, despite employing more economists and even Morgan Stanley, Goldman Sachs, and JP Morgan added together. So there you go. That's the reality. Now, what does this actually do for you? Well, it's very interesting, and you'll be pleased to hear that my instincts about what this would do were wrong. Theoretically and in practice, what this means is that the ECB has now got a wonderful excuse to keep monetary policy easier for longer, and to go on financing government bonds, so that the combination of monetary and fiscal policy in Europe works to the advantage not only of the new generation EU plan for investment, green and communications technology and a whole lot of other things, but also for keeping countries with very high rates of debt financed at low interest rates so they don't go belly up. Now, I'm not saying that's a good thing or a bad thing, but the reality is that what this revised framework does is give the ECB a license not to kill the economically over-indebted, inefficient, and to give them a break and to allow them to use resources being put up by both the central bank who buys the bonds and governments who spends the money, to allow those countries to use those resources in order to get efficient again. Will they get efficient again? Well, the one to watch there is Italy, and in the pilot seat is the eminent and miraculous Mario Draghi, who if anyone can turn Italy around, it will be him. And we will know, I think, pretty clearly by 2023. So that's what has happened. Now, what I thought would happen would be that the indications that the framework meant a weaker monetary policy for longer by the ECB, I thought the euro would actually weaken. It didn't. It strengthened by about a cent against the US dollar if you take from the period just before this policy was announced, this framework was announced, to today. So it doesn't sound very dramatic unless you're a hedge fund manager, when it can be very dramatic if you were betting on a weaker dollar, weaker euro. Why did this happen? Well, it's very interesting why it happened. It happened because a very large number of particularly US hedge funds were actually expecting that the ECB would announce a policy of a new framework which would be equally lax as the framework announced by the Fed, and it didn't. The ECB framework is lax, but it is not as lax as the Fed because it does not allow for a compensatory period of inflation above target to make up for a period in the past when inflation was below target. The ECB could never do that because the Germans would simply not put up with it. So essentially, it's a tougher, but I wouldn't describe it as tough, monetary policy framework compared to the Fed. The result of that is people said, oh dear, well, this is maybe a recipe for a more accommodating monetary policy for longer, but it is not as accommodating as we thought it would be. So they sold their short positions in euro, which pushed up the value of the euro. Now, I don't think that is particularly sustainable. What is going to drive the value of the euro are other factors. Number one, it was oversold. So we're seeing those excessive short positions being taken out at the moment. That's why it has been relatively strong, the euro. Secondly, for the moment, the euro is going to be driven by the relative growth rates, fiscal stimulus, and all that sort of thing, comparing the United States to Europe. And right now, I think that the US is going to lead the pack, which means at best, we will see relative stability between the euro and the US dollar. However, two things are coming up which can influence this in a different direction. The first thing is the euro is about to take over from the US as the leading growth economy in the world because it is going to recover from COVID, not in a particularly decisive way, given the new strains of COVID, such as the Delta variant, but demand in Europe, we are seeing it come back. We are seeing people say, we've had enough of this disease, we're going to spend our money anyway. We don't care about our neighbors getting this as long as it's not ourselves. The rate of hospitalizations is still quite low. The rate of fatalities is still quite low. The kind of social restrictions are coming off. Let's go to the main square, the piazza, and hug and kiss and do a whole lot of things we haven't been allowed to do. So that's actually now happening in Europe, whereas it happened in the United States some time ago. So the European economy, the EU economy, is going to actually be the growth leader. Now, growth leaders have strong currencies in a world in which people buy or sell currencies based on relative growth. So a little bit of shine comes off the dollar, and then a little bit of shine goes on the euro. The other thing that is going to happen is that the US is incurring deficits which it cannot finance domestically. That is because of the size of the budget deficits. We've talked about that before, and it being a low savings economy. So the rest of the world's savings have to finance the US. That will probably happen at a lower rate of the dollar and higher interest rates in the United States. So in that sense, I would say that once we get out of this kind of period of relative stability where the euro looks not too bad, we will actually see the euro do reasonably well because the US dollar is going to restart its long-term declining trend on a trade-weighted basis. What else does this mean for you? Well, frankly, not a lot. It means that European long-term interest rates are not going to go up because the ECB, despite saying that it's not into yield curve control, it most definitely is because it's buying all the government bonds. So long-term interest rates like the German Bund rate, which is this morning between -20 and -30, not to date this broadcast too much, these sort of rates are going to stick around for a while. They won't be there in a year, but they're going to stick around for a while. So we're not looking at the same risk on interest rates as we are looking at in the United States, where as a result of the Fed meeting, long-term rates collapsed by substantially more than in Europe, and where those rates are now going back to a somewhat normal level, let's say approximately 140 something, 143 on the 10-year paper, and 2 with a couple of zeros after it on the 30-year paper, which I expect, by the way, to be over 100 basis points higher on both scores within 1 year because of the financing deficit. Now, as regards equities in Europe, there is still an argument for saying that European equities should actually continue to catch up with the United States because they've lagged for years, but principally because we're going to see pretty substantial profit growth on the basis of the European economies bouncing back from COVID late, and hopefully that can be sustained. But that is really a question that you should ask your local and favored epidemiologist. Meanwhile, for me, that's it. That's what the ECB has done. Terribly, terribly exciting. In many ways, it doesn't really change chalk from cheese, but they spent a hell of a lot of brain power, effort, committee meetings, and so on, in actually coming up with this new framework. So I hope you found this interesting. Thank you.